The financial markets love a clean narrative, but they notoriously struggle when a company undergoes a structural mutation faster than traditional analyst models can recalibrate. Sitting right around the mid-teens price corridor, SoFi Technologies is currently trapped in a classic Wall Street mispricing zone. Standard financial media and consensus retail commentary continue to pigeonhole the company as a glorified digital lender, dragging its valuation through the mud every time interest rate jitters or macro headwinds hit the credit markets. Yet beneath this outdated legacy framing lies a completely different operational reality. SoFi has successfully engineered a high-velocity financial services productivity loop that is fundamentally rewriting the economics of retail banking. While surface-level observers hyperventilate over short-term loan book fluctuations, institutional accumulators are quietly front-running a massive transition toward a fee-resilient, technology-backed membership ecosystem. This isn't just about personal loans or student refinancing anymore. It's about the relentless compounding of a digital everything app, where customer acquisition costs are steadily amortizing across an exploding matrix of high-margin financial products. To understand the core structural mispricing here, one must examine the fundamental physics of modern digital platform economics. Traditional banks operate under a heavy physical branch drag, saddled with legacy Main Street overhead and archaic tech stacks that make cross-selling a sluggish, friction-filled nightmare. Standard financial media evaluates SoFi using these exact same brick-and-mortar valuation metrics, completely missing the scalable software-like compounding within its ecosystem. When a user opens a SoFi Money account, they aren't just parking cash, they are entering a captive digital funnel optimized for cross-buying investment products, credit cards, mortgage originations, and automated financial coaching. During recent quarters, this flywheel achieved a historic inflection point. Product growth officially doubled member growth in a single quarter, with over half of all new products being opened by existing members. That is the holy grail of fintech scalability, zero marginal cost customer expansion. Yet short-term algorithmic trading models completely gloss over this velocity, treating every macro-driven market pullback as an excuse to flush out retail sentiment, while smart money quietly secures structural positioning. Diving deeper into daily trading volumes and institutional positioning reveals a fascinating tug-of-war between reactive retail sentiment and long-term institutional accumulation. Every time SoFi prints record-shattering metrics, such as consecutive quarters of explosive net revenue scaling past the $1.2 billion mark, alongside multi-$100 million adjusted EBITDA prints, short-term traders often exhibit classic sell-the-news behavior if management chooses to reinvest capital into aggressive top-of-funnel brand scaling rather than immediate short-sighted margin padding. Retail investors, conditioned by instant gratification loops on social trading platforms, frequently get shaken out by these post-earnings volatility chops. Meanwhile, institutional heavyweights with multi-year investment horizons view these algorithmic dips as pristine accumulation zones. They recognize that SoFi has comfortably entrenched itself well above the Rule of 40 threshold, boasting stellar efficiency scores while scaling its tangible book value per share at an aggressive clip. The institutional thesis isn't built on what the company will earn next Tuesday. It's built on the undeniable inevitability of a digital native demographic locking their primary financial lives into an app that simply works better, faster, and cheaper than legacy institutions. Before we unpack the historical baggage that still haunts this ticker, let's pause right here. Are you currently holding a core position in SoFi and adding to your stack during these volatility-driven pullbacks? Or are you sitting on the sidelines waiting for a definitive technical breakout above key resistance? Drop your thoughts in the comments below. To truly appreciate where SoFi is heading, we have to strip away the historical context that still misleads casual market participants. Years ago, the company entered the public consciousness primarily as a sophisticated student loan refinancing startup catering to high-earning young professionals. Skeptics loved to argue that this niche made SoFi dangerously vulnerable to economic downturns, rising interest rate cycles, and regulatory shifts in the student debt landscape. But watching SoFi over the past several years reveals a masterclass in strategic corporate evolution. Management recognized early on that surviving as a pure-play lender was a dead-end street, exposed to cyclical credit crunches. The pivotal turning point arrived with the acquisition of a national bank charter and the technological integration of Galileo and Technisys. Suddenly, the entire architecture of the business transformed. Instead of relying solely on expensive warehouse lines of credit to fund loans, SoFi unlocked the crown jewel of modern banking: low-cost, sticky consumer deposits. This structural shift allowed the company to flood its balance sheet with billions in retail deposits, drastically compressing its cost of capital and completely decoupling its growth engine from traditional lending constraints. Today, framing SoFi as a mere online bank or a legacy lender is as intellectually lazy as calling Amazon an online bookstore. The company operates through three fiercely synergistic pillars: the lending segment, the financial services segment, and the technology platform. While the lending division continues to post robust, record-breaking origination volumes across personal, student, and home loans, even in complex macro environments, the real explosive momentum lives in the financial services and tech ecosystems. The financial services productivity loop functions as a self-sustaining revenue compounding machine, driving non-interest income and high-margin fee-based revenue that cushions the business against any potential credit cycle normalization. Simultaneously, the technology platform provides the underlying infrastructure backbone for external fintechs and financial institutions, embedding SoFi directly into the plumbing of global digital finance. This diversification means that even when macro headwinds cause episodic jitters in consumer borrowing behavior, the software and fee-based pillars continue to scale aggressively, smoothing out earnings volatility and proving the absolute durability of the business model. Looking out toward the multi-year horizon, SoFi's growth catalysts are deeply rooted in its positioning as a technological gatekeeper and a dominant consumer brand. Unaided brand awareness has scaled dramatically over recent years, catapulting SoFi from a niche online lender into a household name recognized by millions of digital native consumers. Accolades like topping major consumer satisfaction and banking indexes validate that the user experience is translating into intense brand loyalty. As younger generations completely abandon physical bank branches in favor of digital-first financial hubs, SoFi stands front and center to capture an ever-growing share of primary bank account designations. Furthermore, continuous product innovation, ranging from integrated digital asset capabilities to advanced AI-powered financial tools, ensures that the platform remains sticky, capturing higher lifetime value per member. Of course, prudent risk management requires acknowledging macro vulnerabilities, including potential spikes in consumer credit default rates during severe economic downturns, regulatory pressures surrounding digital banking and lending practices, and the perpetual necessity of out-executing fierce competition from legacy banking giants desperately trying to modernize their own software stacks. Yet, when you weigh these execution risks against the secular tailwinds of digital migration, the capital expenditure discipline of management, and the sheer velocity of member acquisition pushing toward the mid-teen millions and beyond, the short-term noise of daily stock price fluctuations fades into total irrelevance. Wall Street analysts obsess over quarterly guidance integers, but master wealth builders keep their eyes firmly locked on the secular horizon. SoFi is methodically building the definitive financial utility of the 21st century. For investors who can look past the immediate emotional turbulence of Mr. Market's daily mood swings, the current valuation represents a rare window to accumulate shares in a category-defining enterprise, just as its true compounding potential begins to hit escape velocity. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.